Hey everybody, it's Seth and Paul for the podcast. How are you? It's not a podcast, Paul. It's really a
Why do
show.
you keep saying podcast?
Because we said podcast for so long. How are you?
We've only been doing a YouTube channel for a year, and you still say podcast?
We're sitting in Paul's Mexico home. Paul, you and I, the camera's here. The Pacific is behind it. It's an incredible view. Unfortunately, you at home don't get to see it because we want to get some nice light on us. But we're here in Mexico. It's a new year, Paul. Happy 2021. And bigger and brighter things moving on away from that terrible year of last year. But
why was it terrible?
Well, you know...
I'm just kidding. It's a matter of perspective. That's my whole point about it.
That's true. I mean, I also got to spend a whole year with my family and my kids.
And you got divorced because of that.
I did not. Beth, I love you. And Paul's wrong. For all our new subscribers, we welcome you in. Thanks for joining us as always. Paul, talk about the markets. It's basically, is the first trading day of the year? No. Friday was?
No, it's the first trading day.
Talk about what's going on in the markets today.
Well, it keeps going lower today. S&P is down 2.2%. Basically, Dow, S&P, and NASDAQ are down over 2%. And then we also saw Bitcoin is down a lot today. It hit 34.5 this morning, and now it's at 31.3. That's a drop of pretty hefty drop there. So yeah, I mean, listen, it's a good start to the year for a guy like me who's bet against the market, but I'm still in the loss. I'm still in the negative on my S&P short.
Yeah, you've been very happy this morning, praising that the markets are down. Most people would be very upset about that. Tell me your thought process.
Fundamentals and value matter long term, and I'm betting on fundamentals and value. And right now, the S&P should be, in my opinion, sub 1,800, closer to 1,500 in terms of value. So that's a big drop of 50% from today, which is a hard thing for people to fathom and swallow. But if you look at history, we've had many 50% drops in history, and it happens at very high valuation numbers. And right now, our valuation is at probably the highest in history on many metrics.
So I brought up Bitcoin because some of my friends are still saying, should I get on? Should I get off the train? I was definitely on a few years ago. We've talked about this before, but like I said, we just talked about it. The article said Bitcoin's dropping 17%. Like, talk about the volatility and what if people are interested in this, what they need to understand.
Bitcoin's no different than any high-flying stock. Volatility is when it goes up a lot, it can drop a lot. That's just human nature. The pendulum swings. The further the pendulum swings to one side, the further it go to the other side. So when you're looking at these quote unquote investments like Bitcoin, Tesla, Amazon, things that have big movements daily, you just have to be able to experience big moves on the downside as well. To not accept that is to be blinded by what caused the big rise. I mean, that's just a fundamental part of ups and downs of the market. So, you know, if you're okay with that, you still think Bitcoin's going to the moon, you're good. Buy Bitcoin, but don't be surprised if, I mean, look at Bitcoin. It hit 19.6 in December of 17 or 18?
18, yeah.
18, when as low as 3,000, and now it's at 31 and change, 31,000. That's 10 times growth in the last year or so, year and a half. So it all depends on what you're looking at.
You know, I said, I brought up right before the show, I said, you know, you urge people not to jump on the Bitcoin train, but I always say is like, ignorance is bliss. Had I jumped on, I'd have this huge upswing, and yes, it's dropping. And then your first notion is, well, what if it keeps dropping?
So here's what happens in bubbles. Big rise, quick fall, then it rises back up. Quick fall, rises back up. And people go, see, every single time it drops, it goes right back up again. It sucks people in. It sucks people in to say, like, this is and eventually the big bubble pops and it doesn't just fall and go back up again. It just keeps falling. Go look at every bubble in history. This has happened time and time again, going back 400 or 500 years. It always sucks people in, gets people to believe again, and then finally everybody's the first one. Everybody thinks they're gonna be the first one to walk out the door because they're gonna say, oh no, this time is the real time. You never know. If you're sucked in at 31,000, you have no reason to leave at 15,000. You have no basis for understanding the fundamentals of anything at that point. So that's when Seth talks about Tesla, and I said, you wouldn't have sold Tesla. He's like, but I did sell Tesla. I'm like, yes, because you understood the fundamentals. Had you not understood the fundamentals, you'd have never sold Tesla, and therefore you'd have ridden it all the way down to a point at least where you said, I'm done, I'm giving up, and you probably would have lost 90% of your money at that point.
Yeah, I mean, there is this, as you described and as we tell you as our viewers sometimes, there is this constant struggle with like knowing the fundamentals of a company and perhaps ignoring your Uncle Paul and just going for it. Like, how long should it take one of our viewers to get to this understanding? Like,
it took me years.
Years, yeah.
Yeah, but you gotta surround yourself by the people that make sense to what you're saying. If what I'm saying to you doesn't make sense, then you should find somebody who makes sense to you. I'm not for everybody, but for those who understand that cash flow probably is a better way to invest, this is the channel for you. And I'm not going to be offended, and you shouldn't be upset at me for thinking the way I do. More power to you. But you got to remember there's fundamentals and there's momentum. I focus on fundamentals. I do momentum on other things. And I'm not saying Bitcoin is not a momentum play. I'm not saying Tesla is not a momentum play. In fact, they probably are. But you cannot, in my opinion, you can't mix the two. It's either momentum or fundamentals. And I'm sure there are people out there who mix the two. I've read about that, but I just don't like to mix the two. I like to keep my thoughts completely separate.
You know, along similar lines of hype stocks, you know, NIO went up 10% today. And apparently there's some, on January 9th is like NIO Day. It's like Tesla's battery day, where people are expecting this huge upswing. Like, do you ever play into this? Do you ever play into this hype of what's to come?
So right now, for everybody who follows us, we have a Patreon. Everybody who's in the Patreon in the next few months will be getting access to our website. I am building this website not just for our users, but also for us internally. We want to do more momentum investing. We want to do more momentum trading. That will be a big component of some of our money, because we do believe that momentum does build on itself and you can make a lot of money playing momentum. But again, momentum's in this basket, fundamentals in this basket. I don't ever mix the baskets. That's my personal, it's what makes me sleep at night. I have a set budget, a set dollar amount for momentum investing and a set dollar amount for fundamentals. And I stick with it.
Why does it seem like so many, I mean, I kind of know the answer, but why does it seem like so many people are so drawn to like these crazy hype stocks?
Because it's fun to see stocks go up 10%, 20% a day.
These other videos on YouTube, these guys are just like, I have this amazing news,
10x.
just explosions, and NIO's just the best. It's just like, wow, really? That's really enticing. Like,
of course.
They must be right? I mean,
it's not fun. Would you rather have, it's more exciting to have one stock go up 100% than 5 stocks go up 15%.
Well, I've said this to you. Oh, I see. Yeah, of course.
Six stocks go up 15%.
I mean, I've said this to you. Like, if I can make 10% or more on a return per year as a normal person, that sounds great. So if I can make 10% on a Monday morning with NIO, I can make up my whole year. Like, it seems so enticing.
But then you can also lose 10% on a Monday morning.
And lose the whole year.
Lose 2 years then.
Oh, I see. And that really hits hard.
Yeah.
Damn. Yeah, that's tough.
I mean, it's all what makes you, but if you don't have even for momentum investing, if you don't have a set system and process, you're just throwing darts at the board, and you might as well just hire a monkey to do that, because that's exactly what you're doing.
If you like what you're hearing, as always, make sure you're tickling that thumbs up. Paul, you do like being tickled.
I do like being tickled. I like it when you tickle me. The weird part was last night I woke up.
Yeah, so just tickle that thumbs up, and we really appreciate it.
Are we gonna do a stock?
You subscribe. You want to talk about a stock?
I would love to. What do we want to do?
Paul's going to show a stock today that's happening.
Let's share my screen so I can look at my little list.
Go ahead. See what's going on in your world.
Okay, this is my screen of stocks I'm following.
No, I definitely own some of these, Paul. AMC, Quest Diagnostics for sure. HP we own together.
What about CBRE?
What is that?
CBRE, CB Richard Ellis. They're a brokerage firm, the biggest in the world, maybe? Let's see. Are they the biggest in the world? I don't know. But they not only broker deals, they also manage real estate, manage properties for people. And I really like them a lot from a value standpoint. Their PE is 19. So let's go through it. First off, they're a $20 billion company. Mm-hmm. PE of 19, so that's a check mark so far. Profit margin is 3%. I believe that profit margin is low because of the recent quarters.
Okay.
So I don't know if so it's still an X. It's an X there, but still, I think there's still potential there.
So pillar number 3 is revenue growth.
Okay, so let's go to our annual look at revenue growth. So if you look here, 10.86 all the way to 23.89, check mark.
That's huge. Okay.
I'm quite sure there's an acquisition in here somewhere. Right here, there's probably an acquisition. They go up 70% in 1 year. It usually doesn't happen for such big companies.
So profit growth is pillar number 4, Paul.
547 to $1.2 billion. Check mark there.
Number of shares outstanding is pillar number 5. We want the shares going down.
It's actually going up, 332 to 335. It's actually going up. So that's an X there, but that's okay.
Okay, how about pillar number 6, which is current assets greater than current liabilities?
7.8 billion versus 6.15. That's a check mark. And they don't even have a lot of liabilities in general, 9.75 total. So they only have 3.6 in long-term liabilities. So that's for a 23 billion revenue company to only have 3.6 billion in liabilities. I don't know an exact ratio if it should be. It all depends on the industry, but that makes me feel warm and fuzzy inside.
How about free cash flow growth, which is pillar number 7?
All right, you have that calculator out, my friend? Ready. So the first year in the 5 was 510, and then 1 billion, which is plus 1,000. Mm-hmm. So that's definitely a check mark there. So the seventh pillar of free cash flow growth is a check mark. And then the other years were 430, 710.
Highlight where you're looking.
Oh, 710. And call it 900. Now remember, guys, free cash flow is what a company's going to use to pay dividends, buy back shares, make acquisitions, things like that. Things that are going to increase value for investors. I look at free cash flow the most out of anything. What's the average over the last 5 years?
So the free cash flow average for what company is this again, Paul?
CB Richard Ellis.
CB Richard Ellis.
CBRE.
CBRE is 710 is the free cash flow per year.
Okay, so 710 times, let's say 20. I don't know what the exact number is. Now, this is the most common question you get is, why do you multiply by 20? On a company like this, which is so big, maybe, now look at this, the last 12 months, look at this, Seth, share my screen again, would you?
Sure.
The last 12 months, they've had 1.63 billion in free cash flow.
As opposed to 710.
Yeah, so over double in the last 12 months, right? So this is an important thing to think about. They're on the upswing here. Now, I don't know why that is, but the bottom line is it's something to consider. So I think multiplying by a factor of 20, because there was a lot of growth along the way, is a very conservative number, very good. And that puts us at a $14 billion value versus 20. So we need the stock to drop about 30% here, which at $60, $42 a share. Here's the good news.
But let's slow you down real quick. So what we did, folks, we took the free cash flow per year average, although it's increasing, and we multiplied that times 20 to get to the desired market cap we want to pay for this company, which is 14 billion.
Yep.
And it's at 20 billion. So it's the market is telling us that it's currently overvalued in people's eyes.
Based on our metric. Now, if you go based on last year's revenue, free cash flow,
yes,
it's probably actually undervalued. But the question you have to ask yourself is, in the last 12 months, has revenue caught up quickly where a lot of money came in because of the shutdown and all of a sudden there was good timing? I don't know. If you find out that no, business is just permanently at a plateau, this is a good value play right now. I have a hard time believing that the place, based on where the economy is, the global economy is, et cetera, that CBRE is going to be majorly growing over the next 5 years. So I think that's going to be a hard pill to swallow. So then what I do is I take my $14 billion value and the company's currently at $20 billion. So basically that's a 30% drop, correct? Mm-hmm. The stock has to fall by the company has to fall by 30% in value to get to 14 billion. So the stock's at 60, 30% of 60 is 18. So 60 minus 18 is $42 a share. So I'm looking at this company around $40 to $45 a share. And it was there in October.
And at that point, you like this company? I'm
sitting there saying, yeah, I think I've written some puts on this company at that low sub 40 level. Because, I'm a value investor. I want to get a much lower amount than just the value that I think it's worth. Do you know what I mean?
Yeah.
So these are the things we think about. The hardest part is the price of free cash flow. We get that question all the time. You just got to remember that it's a subjective, this is the art of investing. It's a subjective standpoint of how you're going to look at this company.
Do you want to look at your Excel or no?
No.
Not for this company.
Not for this company.
Guys, we appreciate you following along. We do so many videos a day. It's 2 put videos a day, Paul?
2 put videos at 1 p.m. Eastern and 7 p.m. Eastern time. We post every single day.
We will be live streaming Tuesdays and Thursdays at 1 p.m. Eastern time. And this week, patrons, pay attention. We will have your Patreon-only live stream this coming Wednesday night with Paul and I and Trader Mo, who's sitting on the couch behind us here. And we'll talk about everything, Paul. Lots of updates. Reading 10Ks, talks about options, Paul, puts and calls. It's going to be incredible. And for our amazing Patreons that support us, you will be the only ones invited to bring your questions. And we love you guys. Paul, thanks for joining me as always. We'll do a zillion more of these. And we'll keep looking at the markets for you. Subscribe, like. We love you guys. Appreciate it.